level with the American public. The government is broke. We can't afford all of the commitments that we've made. We can't pay all the money to all the people. There has to be cuts in government spending, including entitlements like Social Security, Medicare, and we can't make the bondholders whole. We don't have the ability to service a $35 trillion debt.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vierra, part of the outreach team of Silver Bullion here in Singapore, where we want to help you truly secure your wealth. Internationally recognized economist Peter Schiff joins us today. Peter specializes in the foreign equity, currency, and gold markets. He made his name as president and chief global strategist of Euro-Pacific Capital and Euro-Pacific Asset Management. And of course, the famous and correct call he made with the 2008 housing bubble crisis. And we're delighted to have Peter join us once again today. It's time to saddle up and silver up for Peter Schiff. Peter, welcome back to SBTV. How are you doing?
I'm doing well this morning. How are you doing this evening?
I'm doing great. I thank you for asking that. I want to start off with your collaboration with James Hickman, Schiff Sovereign. Can you tell us how the collaboration came to be, or what prompted you both to agree to make it happen?
Well, I've known James for quite some time. I participated in some of his total access events in the past and actually some of his bigger conferences. And so we became friends. I'd been out to his farm that he had in Chile, and he was living in Puerto Rico as well. I mean, I moved here originally. He was making fun of me for moving to Puerto Rico until he moved to Puerto Rico himself. So, we have a lot in common, and he's got this newsletter that he writes, and, I don't really have one. I mean, I didn't have a paid letter or anything. He puts out a lot more content, written content than I do. I do the social media that he doesn't really do, as far as, my YouTube channel and my engagement, let's say on X and other social media. So we thought it would be a good idea to kind of combine what I'm doing with social media with what he's doing with publishing and newsletters. I mean, I've written a few books, but haven't really written one in over 10 years. And so it seemed like it could be a good business to kind of combine. And also we see eye to eye on just about everything. I mean, not 100%, but on pretty much, most of the stuff. And, he's quite a bit younger than I am. I mean, he's in his 40s. I'm in my 60s. So somebody that can kind of carry the torch as I get a little older, who can be out there messaging, so maybe at some point he can transition and get him into the podcasting, get him into, Shift Radio and things like that. So he can be there. My kids are quite a bit younger, so they're not, really ready to go. My older one doesn't have much interest in the business. And then I've got younger kids who are way younger, so they're they're maybe 15 years away from being able to do anything if they even want to. I mean, who knows? So it seems like a good, just like Donald Trump gets J.D. Vance in there, who's quite a bit younger than he is, who potentially, I guess he thinks, hey, this guy can carry my legacy into the future, and so when I want to take an even bigger backseat in some of the things that I do, James could be there to continue the effort.
All right, that's a great story. I guess once James gave in to all the good things in Puerto Rico, I guess you guys saw a lot more eye to eye there afterwards.
Yeah, he doesn't spend as much time here as I do. He doesn't have the kids. He has a couple of kids now because he got married not too long ago. But his
Right.
kids are really young, so they're not even starting school yet. So he's got a little time before he has to, really stay in Puerto Rico, because part of your closer connection really is got to get your kids in school here. If that's one way to show that you live here. It's where your kids go to school. But I don't know. He may homeschool. There are still a number of people here that do homeschooling. By the way, if people, as long as we talked about it, people, if they want to sign up, Schiff Sovereign, we have a free newsletter at schiffsovereign.com. Comes out about every day. It's a great read. In fact, I used to read a lot of James's stuff in the past because it's well written. It's good stuff. And so it's a free letter. You just go to schiffsovereign.com, and if you're willing to pay a few bucks a month, well worth it. You can sign up to be a member of Schiff Sovereign Premium.
All right. Hey, it's Jackson Hole time, and that means hearing more of Fed monetary policy and outlook for the rest of the year, what we might call guidance. Expectations are the Fed will cut rates in September. First, Peter, do you see the same? And second, whether it does or does not cut rates, will there be any significant impact?
Well, I think if they don't cut rates in September, the markets may not like that because they're pretty much pricing in a cut, which is why I expect the cut to happen. The question is, are they going to go 25 basis points, 50 basis points? That's kind of where we are. But the broader point is that they shouldn't be cutting rates at all. In fact, not only should they not be cutting rates, they should be raising rates. They stopped raising rates too soon. Monetary policy never really became restrictive the way they claim. And the reduction that we've had in the official measures of inflation is only temporary. And I think that these rate cuts that are contemplated and will probably start in September will be the catalyst to cause inflation to rise to new highs, at least the way it's measured by the CPI. You know, the Fed claims that it's data dependent. Well, the most important data point when it comes to monetary policy and whether you're too loose or too easy is gold. And in fact, Alan Greenspan, who used to be the Fed chairman, when he was asked about it, he said that he uses gold. And at the time, gold was around $350 an ounce when he was answering this question before Congress. And he said, well, if I see the gold price up about 400, I know that I'm too easy. And if the gold price goes below 300, I know that I'm too tight. So he said, we're not officially on a gold standard, but unofficially we are, because I use gold as a guiding, a light to set policy. So I know if we're too easy or too tight. Well, by that, data point, gold's at 2,500. Gold's at an all-time record high. Gold's moved up 25% so far this calendar year in anticipation of the Fed cutting rates. Well, what does that tell you? That these rate cuts are a mistake. That is the data point that the Fed should be looking at. Also, look at the dollar, which hit a new 2024 low this week. It's now back to where it was in December of 2023. But what's more important is the trajectory. The dollar is falling, and it looks like it could fall substantially. Again, this is the currency market saying you're making a mistake, because the weak dollar in and of itself is going to push up consumer prices because we buy stuff with dollars. America has a $1 trillion a year trade deficit. We import all sorts of products that we pay for with dollars. Well, if the dollar goes down, the price of all those products has to go up by definition. So the Fed is about to make the inflation problem worse by claiming that it solved it. Right? So they're actually not cutting rates because they won the inflation war. They're cutting rates because they lost. It's a surrender, because they're looking at the impact that the higher interest rates are having on the economy, on employment, which is something that has to happen, because the low interest rates is the artificial support that boosted the economy. It created based on debt. And so when you raise interest rates, you make that debt that was accumulated when rates are low a big burden on the economy. So there's no way to normalize interest rates without collapsing the artificial economy that was built on top of the cheap money. But now the Fed doesn't want that to collapse, so it has to go back to the cheap money, which means we're going to get a lot more inflation.
Whatever they should do, I mean, how do you see the jobs market? Do you see more unemployment coming, or do you see maybe people getting back to work?
Well, there's a lot of more unemployment than the government admits to. A lot of it is the way that it's calculated, because so many people have left the labor force that it really skews the unemployment numbers. And also the way we count the unemployed now is very different. We made a major change in 1994 to the way we figure out who's unemployed. And we took a lot of people that used to count, and we decided that they don't count anymore as unemployed. So that's the real reason the number is so low. In fact, we still report the number that we used to use, but it's it's beneath the headline, so nobody notices it, but it's called U6. And U6 was the actual only unemployment rate we used up until 1994, when they came up with U3. But what U6 does is it counts people who are unemployed, who want jobs, but they're just not looking anymore because they're discouraged. They've just given up. We don't count them now. You have to be out there looking for a job. And if you're not out there looking, you're not unemployed. Even though you're not working, and even though you'd want to work, the fact that you've given up hope means that you're no longer in the statistics. Then there's another category of people who have a part-time job. Let's say I've got a job and I work, 5 hours a week. But for the rest of the time, I'm looking for a job. But meanwhile, I got this little gig that I got 5 hours a week. They're not counted now as unemployed, because as long as you do 1 hour of work somewhere, even if you spend the other 40 hours a week looking for a better job, you're not counted as unemployed anymore. But in U6 you are, right? And they used to. So if you look at the U6 number, it's not 4.1. I think it's 7.9, or I forget what the last one was. It's actually, or it's pretty high. In fact, I looked back at the 53 years before 1994 to 1941. I'm not looking at the Depression because unemployment was high during the Depression. But starting after 1941 to 1994, there wasn't a single year of those 53 years where the unemployment rate ended as high as it is right now. So if you want to compare apples to apples, we don't have a low unemployment rate. We have a historically high unemployment rate. And it's going to get a lot higher. Meanwhile, the jobs that have supposedly been created are a myth. The vast majority of the jobs that Biden takes credit for creating were jobs that existed before he was elected. It's just that those jobs were on hold because of COVID. So the companies furloughed their workers because of the COVID lockdowns when Trump was president. Biden comes in, the economy reopens, and the businesses say, okay, everybody come back to work. Biden is calling those jobs that he created, but they were already there, right? Then, if you look at all the new jobs, in addition to those jobs, the restored jobs, that's all a myth, because we have fewer people that have full-time jobs now than when Biden was elected. So the jobs that were created under Biden were second and third jobs, because Americans could no longer make ends meet. There was so much inflation created that people couldn't get by on one job anymore. So a lot of people had to go out and get a second or a third job. Those are the jobs that are created. But the people who have those jobs would prefer not to have them. They don't want them, they need them, because their other job no longer pays the bills. So it's moonlighting, it's an explosion of moonlighting. And by the way, they also looked, if you dig deeper, all of the net new jobs went to immigrants. Whether they're illegal or legal, they didn't go to people who were born in America, right? They lost jobs. The net gain came to people that moved to America. So that also tells you something. And again, a lot of the jobs are in government, which are only here because we run huge deficits to provide people with government jobs. These are not productive jobs. We don't need these people. They're not producing anything that improves our lives, but we have to pay their salaries with inflation because we end up running higher deficits. So these are non-productive jobs. Then the other jobs are part-time jobs, in restaurants, in hotels, in bars. There's some healthcare jobs. We've lost manufacturing jobs. Those are the jobs we need, yet those are the jobs that have been destroyed during the last 3.5 years. So they were being destroyed even before Biden came around, but we've destroyed even more. So that's why the manufacturing industry has been in a recession for almost the entirety of the Biden presidency. Even by the government's own numbers, manufacturing's in a recession. Now, I think the whole economy is in a recession because I don't believe the numbers. But even if you take the numbers on face value, manufacturing's in a recession. And that's part of the problem with inflation, because we're not producing enough stuff. All we're doing is printing money to buy stuff that we don't produce, and so prices go up. And they're about to go up a lot more, once the Fed starts cutting and we start to see the impact on the weak dollar and what that does to commodity prices in particular.
If you're enjoying this interview with Peter Schiff and I, please do consider subscribing to our YouTube channel and giving us a thumbs up. And did you know that at Silver Bullion, there are 6 different types of accounts to fit your needs? To find out more, go to www.silverbullion.com.sg, click on the signups tab, and choose from these 6 types of accounts. Or email me, Patrick at silverbullion.com.sg, and I'll help to get you started. The ripple effect, let's say, of people having a bit of a harder time with employment and inflation. You think this is going to eventually wash up on the housing market where people bought homes on the top end?
The housing market is very different now than in the last bubble, because during the last bubble, people had a lot of teaser rates, people did a lot of ARMs, and all those things reset. And so it was very difficult for people to make their mortgage payments. But when real estate prices dropped, even the people that could make their mortgage payments didn't have an incentive to do it because they were just throwing money away. They were just, the house that they bought for $500,000 was worth $400,000, so they were negative $100,000 in equity. And why keep sending money to the bank when it's, none of it's in your pocket? You could just mail in the keys and go rent something for less money, because people were struggling to make their mortgage payments because they thought they were going to get rich on the appreciation. Well, when markets went the other way, they exercised their free put and they moved out, and so the banks were in trouble. But now it's different. Most people own long-term fixed-rate mortgages at very low rates. Probably most people are in the 3s, maybe some in the 4s, and there's a few lucky people that are in the 2s, right? But so people do not want to leave. The price of everything has gone up except their mortgage payment. Their mortgage payment has been fixed. And so their mortgage costs have actually gone down in relation to everything. So people don't want to move out. Even if they want a bigger house or something, they can't leave. They're trapped because they got such a great deal on their mortgage. Now, they're still hurting because their taxes are up, their maintenance is up, their insurance is up. But the one thing that's not up is their mortgage payment. And that's the only thing they can control. Rents have gone way up. So people who are renting, they're paying much higher rents. But if you own a home and you had a fixed rate mortgage, so the market is locked. People aren't selling their homes. And the problem for the banks, in 2008, the problem was when people stopped paying their mortgage. The banks were in trouble because they had to sell the house, and it had dropped. So the collateral behind the loan was no good, and they were losing money. They're actually in a much worse position today. The problem with the banks is not that people are defaulting, but that they're staying in their homes and keeping their mortgages, because the banks are losing money on every mortgage they wrote, because they loaned out the money at 3 or 4%, and now they have to borrow that money from the Fed at over 5%. So all these mortgages that were profitable for banks when rates were at zero are now unprofitable. They're losing money, and they're losing a ton of money. Plus, they have to deal with the crisis in the commercial market, which they didn't even have in 2008. So we have a completely insolvent banking system, which is the other reason that the Fed stopped hiking rates. In fact, it's not a coincidence that the rate hike stopped when banks started to fail, right? That's when they stopped, right? They hiked rates until the markets broke, and then they backed off. But they're going to cut because they're trying to prop up the banking system. They're trying to prop up the government. Based on the most recent numbers, 25% of tax revenue now goes to interest on the national debt. Interest on the national debt is now more expensive than defense. It's the third biggest expense the government has behind Social Security and Medicare. And in another year or two, it's going to exceed Social Security and Medicare. So the Fed is trying to do something to ease that burden. And what can they do? Lower rates so that it's not as expensive for the government to finance its existing debt or to finance new debt, because our debt is rising by $3-4 trillion a year. Just look at the national debt. Look at how rapidly it's going up. So this is why rates are being cut. It's not because the Fed won on inflation. The Fed lost. inflation won. Of course, the Fed created the inflation, and now they're going to create a lot more.
Peter, that interest rate payment, it's kind of a scary thought. I mean, what are things going to be like when the payment on the debt 30, 40, 50% is just on interest alone?
Well, what's going to happen is the Fed is going to have to finance it. It's just going to be more and more monetization. So, that's the type of monetary policy that they had in Zimbabwe, right? Or that they have, they had in Argentina, although now Argentina is cleaning up its act under Milei, but you could look at other countries, Venezuela comes to mind. That's how they finance their government spending, with a central bank creating the money. And so you end up with runaway inflation. I mean, that's where we are headed. Nobody in Washington has the political courage to level with the American public that the government is broke and that we can't afford all of the commitments that we've made. We can't pay all the money to all the people. And so there has to be cuts in government spending, including entitlements like Social Security, Medicare, and we can't make the bondholders whole. We don't have the ability to service a $35 trillion debt, let alone repay it. And so there needs to be a haircut here. We need to have a restructuring of debt so that it's affordable. But that's not going to happen because the government's going to say, why should we make any of those difficult choices? Why should we have to acknowledge how badly we screwed up? We have a printing press. We'll just use that. And so problem solved. We don't have to, cut spending. We'll just give everybody what we promised and we'll print the money to do it. Well, then nobody gets anything of real value. I mean, the government can give you money, but what they can't do is give your money purchasing power. Only the free market can do that. And if you flood the market with paper, prices are going to skyrocket. And that's what's going to happen. And it's the same thing as default, only it's a dishonest default. You repudiate your debts with inflation instead of honestly restructuring them. And inflation is always worse. It's always better to restructure your debts honestly and for government to just cut back on its spending and give people less money than not to cut back and give everybody money that doesn't buy anything, right? Because that's the worst thing, to have a bunch of money but have nothing to buy.
I'm thinking about it here, trying to restructure 35 plus trillion, not even counting, the social security and everything else. Is it even possible to restructure, or are we really looking at, let's wipe everything off the board and start over again?
Well, I mean, it is possible. The question is it politically viable? Will anybody do it? Right?
Yeah.
And it's so much easier just to inflate. And that's the path that the politicians always choose. Now, of course, they don't set out to have hyperinflation. They think they can control it. We just need enough inflation to bring down the real value of debt to some serviceable amount, right? Let's say our debt to GDP is 125. Well, if we can double the GDP with inflation and the debt stays where it is, then it's not 125 to GDP. Now it's 70 or 60, 60, whatever the division is, 62 and a half, whatever. So, but the problem is right now, our debt is still growing faster than our economy. So it's getting worse. But they think, okay, if we can just ramp up the growth rate, even if it's phony growth, that's inflation, just prices going up, we can bring down the burden of the debt because the debt is fixed, right? So you create inflation, the debt is where it is. But the way our budgets are now, we're so out of whack that the new debt that we're adding, even though every year we inflate away some of the existing debt, right? Inflation erodes that debt. The problem is we're piling on new debt so fast that it actually exceeds the amount of the debt that goes away due to inflation on the principal. So even though we have inflation, the debt burden is getting bigger and bigger. So they're going to need even more inflation to try to make headway. But eventually that gets out of control, right? It's like Frankenstein's monster. Frankenstein creates the monster, and then eventually the monster turns on the creator. So the government creates inflation because they think inflation is going to be its friend. They think inflation is going to help it, avoid all these problems, and it ends up, biting them, and it makes all the problems worse because it runs out of control, and now they have no ability to rein it in. It just becomes, hyperinflation.
You touched on 2008, what happened back then. Is it fair to say that in 2008, the world was bailing out the US while the US was bailing out Wall Street?
Yeah, I mean, and it wasn't just Wall Street, but yes, I mean, a lot of the big banks should have failed, and we should have let them fail. That was a mistake to prop them up. But yes, the reason that we were able to get away with it was because the rest of the world financed it. They financed our quantitative easing. They bought the treasuries that the U.S. government sold so that Wall Street could get bailed out. Absolutely. And that's why then you had all these foreign central banks who were trying to prevent their own currencies from rising during that time by buying up dollars and creating problems for their own economies. I mean, we basically exported a lot of our problems to the rest of the world. That's why the whole world was really suffering, not because we had the crisis, but because they bailed us out. If they would have allowed the situation to be worse in the United States, it wouldn't have been as bad outside the United States.
The Bank of Japan situation, the opposite of cutting rates, which the Fed wants to do, the BOJ, they raised rates and we saw what happened. Raised rates just 0.15%. Peter, do you think the Bank of Japan will? I mean, obviously they're going to have to pause for a while, but do you think they may go back to lowering rates? And if they do, what message would it send?
It's going to be very difficult for them to lower rates. They still need to raise rates, and they're going to raise rates. They just, they don't know how to do it because you can't do it without disrupting the markets. I mean, they started to raise rates, and the Nikkei collapsed. Between a Friday and a Monday, it was down 20%, and it was the biggest. The Monday in Japan was the biggest decline in 50 years. It was worse than Black Monday, on 1987. And the Bank of Japan panicked on that Wednesday. The market had a rebound on Tuesday, and it was probably going to roll over and make new lows. And then the Bank of Japan came out and said, hey, we're not going to hike rates anymore if the markets are destabilized. And then everybody bought stocks, and everything is great because the Bank of Japan basically said, we're not going to raise rates because there's no way to raise rates without destabilizing the markets. But if they don't raise rates, the inflation problem in Japan is going to get worse and worse and worse. And so eventually they're going to have to do it. The question is, how much longer can they hold out? But, for years and years, the Japanese created inflation under the pretense that they didn't have enough inflation. Well, that was a lie. There's nothing wrong with low inflation. In fact, deflation, prices going down, is actually better than prices going up slightly. But they bought into this nonsense that inflation should be 2%, and that if it's 0.5%, then there's a problem that the central bank needs to solve. Well, that is absolutely ridiculous. You don't have to solve that problem. Prices going up 0.5% per year are better than prices going up by 2% a year. So there's nothing to worry about, right? It's like nonsense. Nobody wants the cost of living to go up. Everybody wants prices low. And if prices go down, that's better than prices going up. Now, people say, well, but what about businesses? They lose money if prices are going down. No, they don't. If their costs go down and their prices go down, they make even more money because they sell more goods and they make it on volume. Look at all the companies that sell consumer electronics, that sell cell phones. Cell phones are a hell of a lot cheaper today than they were 20 years ago. But the companies are making a lot more money today than they were when the phones were a lot more expensive. Why? Because they sell a lot more phones. The lower the price, the more you can sell. So it's all nonsense that economies do better when prices are rising. They do better when prices are falling. And strong economies cause prices to fall because they produce more stuff. More supply means lower prices. So the government was fighting a fictitious battle. The real reason the Bank of Japan kept interest rates low was to suppress the yen and to prop up the government in Japan and to prop up companies that had taken on too much debt that might have gone under had rates been higher. But all of that would have been constructive. Companies going bankrupt that need to go bankrupt, it's better than having zombie companies continue indefinitely propped up by the government. And forcing the Japanese government to cut spending is better than subsidizing massive debt. Now, if you look at the Japanese debt to GDP, it's enormous. 225, 250%. And one of the main reasons the Bank of Japan can't raise interest rates is because the government of Japan can't afford it. The only way the government of Japan would be able to afford to pay those rates would have to be to raise everybody's taxes to get the extra income, but they don't want to do that. So instead, we're going to raise everybody's prices by creating inflation. But Japan is in the same box that the Fed is in, that the European Central Bank is in, that the Bank of England is in. All of these central bankers made the same mistakes. They all kept interest rates too low. They all subsidized their governments to go deeper into debt by doing their own version of quantitative easing, asset purchases. So now all these countries are loaded up with debt, not just on a public level, but on a corporate level, on an individual level, and everything is going to collapse when interest rates normalize. There's no way around that. And that's why none of these central banks want to allow interest rates to normalize, which means everybody is condemned to suffer inflation instead, right? There is no free lunch. We have to pick our poison. So either we're going to have a collapse, financial crisis, asset prices plunge, recession, or we're going to have high inflation, right? So it's one or the other, right? There's no way to get rid of both. We got to decide which one we want. Now, I'd rather have the collapse and get it over with, but then get the government to, clean up its act so that we can have, a more viable recovery in the future that's not based on, artificially low interest rates, inflation, and debt. That's based on savings and production and, good free market forces. But we cover all that up if we take the easy way out, the politically expedient way out, which is just to create inflation. And then one of the reasons that governments prefer to create inflation is because they can blame that on somebody else. Like they can blame that on the greedy corporations that are gouging the consumer and try to deflect the real cause away from themselves. That's one of the main reasons that they redefined inflation over the years, because inflation really is an expansion of the money supply. That's the definition. A result of inflation is that prices go up, but that's not inflation. That's just something that happens when you create inflation. But the governments, with the help of academia and the media, were able to redefine inflation as rising prices. Because when you believe inflation is rising prices, you don't realize that it's the government that's causing it, because the government doesn't raise the prices. It's those businesses that raise the prices. So we blame the price raisers rather than the inflation that caused them to do that. Because if everybody knew that inflation was an expansion of the money supply, how are you going to blame a grocery store? They don't have they don't have a printing press. They can't expand the money supply. They're a victim of inflation just like everybody else.
Decisions. That's a lot to, excuse me, a lot to think about. But Peter Schiff, before we wrap up, I know you got to get to that Jackson Hole. You want to see what's going on there. Can you let the people know how they can follow you on social media and get more of your outstanding work and insights?
Yeah, well, I mentioned they can follow me at Schiff Sovereign by signing up for the free newsletter. They can listen to my podcast, The Peter Schiff Show, which, I do, once or twice a week, sometimes 3 times. But at schiffradio.com, you can do that, or my YouTube channel. Also, follow me on social media. I've done a couple of spaces on X. Probably going to be doing more of those. I've got now just over 1,035,000 followers on X, so that platform is growing. So you should, join there and follow me. I compose a lot of posts. I do all of them myself, so you're reading my actual thoughts as they come to my mind. I comment on stuff that's happening then. It's all fresh and current. So I think it's a good source of information. There's a lot of discussion there. There's a lot of interaction. I get a lot of engagement on my account. So you can talk back and forth with the people who are commenting on my posts. There are people that agree with me. There are people that disagree with me. So it's a good forum to have a discussion about the issues. People can become clients. They can become clients of my asset management company at Euro Pacific Asset Management, Europac.com. If you want me to manage my money, your money rather. And I also have mutual funds that people can buy through their discount brokerage accounts. And Schiff Gold, that's where we sell gold and silver. I know we're all in that business, and people should be buying gold or silver. I think the prices really have one way to go, and that's up. And that actually it's going to be way up. It doesn't mean they can never go down. They will go down, but I just don't think they're going to go down very much. And I think that people might get scared out of the market. The biggest days in gold and silver are generally on the downside, but they're just one day. The trend is up. Gold just hit an all-time record high. We're nowhere near the top of this cycle. Gold prices, I think, are going to move up multiples of where they are right now, many multiples. So we're still very close to the low end of where gold's going to be trading in the not too distant future. Silver hasn't even taken out a high yet. I mean, silver's still under $30 an ounce. It double topped at $50 an ounce in 1980 and in 2020. One day you're going to look back at $50 silver and say, gee, that was really cheap. And with silver, I mean, it's going to blow through $50. And maybe it'll be support for a while before it's really like a launch pad, and the prices go much higher. But it's not so much silver getting more expensive; it's fiat currencies losing value. When the Federal Reserve was first created in 1913, you only needed $20 to buy an ounce of gold. Now you need $2,500 to buy an ounce of gold. The dollar has lost more than 99% of its value ever since we turned it over to the Fed. But if you go back to when the Republic was started in 1789, when we ratified the Constitution, you needed $20 to buy an ounce of gold in 1789. And in 1913, it still was $20 to buy an ounce of gold. So our money had stable value. In fact, it increased in value. Prices were half in 1900 what they were in 1800. So when we didn't have a Federal Reserve, when we had sound money, when we had gold and silver as money, prices went down, and the dollar maintained its value, actually became more valuable. But ever since we turned it over to a central bank, the dollar's been destroyed. But I think what they did in 100 years, they may do in another 10 years. So the dollar could lose 90% of its value, not in 100 years, but in a decade. And so what's going to happen to the price of gold in that circumstance? It's not going to be 2,500, it'll be 25,000. And that's just 90%, not 99%. Then you'd have to add another zero. 250,000. I don't know that it's going to get that bad. But if we end up with hyperinflation, it will get that bad. We just don't know yet how bad the inflation is going to be before the politicians finally and reluctantly do the right thing. But it's going to be a lot worse than it is right now. And so that means gold and silver prices are going to be much, much higher. And so people should act now to get rid of their fiat currency and buy gold and silver. Not because it's an investment, but because it's a form of savings. It's a way to protect your purchasing power. It's better than keeping your money in cash. Even if that cash pays a small amount of interest, it's still not enough to offset the inflation. So it's still a negative interest rate. And so a zero interest rate on gold is better than a negative interest rate on cash. And sometimes if you think that assets are too expensive, if the stock market is high, if real estate is overpriced, and you want to have dry powder, it's much better to keep your dry powder in gold and silver than in a fiat currency, because it's possible that when you need the dry powder, your fiat currency is going to be all wet because inflation is going to destroy it. I mean, even if asset prices come down, they may not come down in terms of dollars or euros, but they really could come down a lot in terms of gold, which is what I expect. I expect ultimately we're going to have deflation. The government is doing everything it can to prevent assets from deflating, but it won't work. Prices will deflate, just not in their fiat currencies. They can control that. They can make sure that prices always go up in the currency that they create, because that currency has no real value and they can create as much of it as they want. But what they can't prevent is prices from collapsing in terms of real money that they can't create, which would be gold and silver. And so that's what people should be holding if you are hoping to take advantage of a bargain, of a fire sale on assets, and you want to have the ability to buy them. The money you should be saving is gold and silver, because that will put you in a much better position, because you're going to see huge declines in prices measured in precious metals versus increases in fiat currencies. If you look at the Dow Jones right now, it's at about 16 ounces of gold. My forecast is for the Dow to be below 2 ounces of gold. I think somewhere between 2 ounces and 1 ounce. But, and that's historically precedent. You had that in 1932, you had that in 1980, 82 time frame. So I think it will happen again. It happened twice last century. And the Dow was 20 ounces of gold in 1929, and then it went to 1 ounce, 1932. It was back over 20 ounces again in 1966, and then it went back down to almost 1 ounce in 1980. We got up to 42 or 43 ounces in the year 2000. That was an all-time record high. But gold over the last 23 years is up more than eightfold, whereas the Dow was only up fourfold. So the Dow has lost half its value priced in gold so far this century. But we're still at about 16 ounces. But I expect that to come down. So how could that happen? Well, it could happen with gold going up to 10,000 and the Dow going to 20,000. That would be 2 to 1. But it could also happen with the Dow going to 100,000 and gold going to 50,000. So it can happen with higher numbers or for the Dow or lower numbers for the Dow. But what's important is the relative price. And if it gets to 1 to 1, right, it could be 10,000 Dow, 10,000 gold. It could be 5,000 Dow, 5,000 gold, which would be a collapse in the Dow. Yeah. But it may be more likely that those two meet at 50,000, maybe 100,000. The Dow's 100,000, but gold's 100,000, right? But in an environment where you can buy the Dow Jones for 100, if it's 100,000 1 to 1, you can buy the entire Dow Jones for 1 ounce of gold. The Dow Jones has collapsed, even if the nominal price has gone up. Even if it's 100,000, it means the Dow has crashed if gold is also 100,000, because you're measuring the Dow in gold, right? That's the way you want to measure all prices. You want to have a neutral yardstick, because if you measure prices in dollars or euros or yen, you don't get an accurate measurement because they're losing value. It's like if you try to measure your height and you used a ruler that kept shrinking, all of a sudden, you're 7 feet tall, then you're 10 feet tall, then you're 12 feet tall, right? You're not growing. You're just using a ruler that keeps getting smaller. So you're not really getting an accurate picture of your height, right? So if you want to measure real prices, you can't use money that keeps losing its value, because you're going to get a false reading. You're going to think the assets are going up when in fact they're not. It's just that the currency you're using to price them is going down. So gold holds its value over time. And so that's a better way to look at prices over time, is how much gold do you need to buy a particular asset.
With that ratio, the gold to Dow ratio, do you see the Dow coming down to gold, or do you see gold going up to the Dow?
Well, I think the Dow is probably going to come down and gold's going to go up a lot, but it's possible that they both go up. It's just that gold goes up a lot more. But the ratio is going to come down dramatically between the two. The stock market in the U.S. is very expensive relative to gold. We have an expensive market, and that's going to change over time. The Dow is going to normalize. And the reason it's so expensive is because of all the inflation. It's been propped up by artificially low interest rates, so we have accelerated PEs. And the earnings have actually been propped up by low interest rates, which have kept their debt costs down, and which have also enabled their customers to buy more of their goods and services because they pay for it on credit. So much of the market is based on the credit bubble, and that bubble is in the process of popping. The air is coming out. And so real stock prices, real asset prices, including real estate prices, are going to come down. But they may not come down at all in terms of money. That comes down even more. But they will come down in terms of real money, which would be gold and silver, which is why people should, be calling Schiff gold and, here in the U.S. and turning their fiat money into real gold. And that goes if you have a crypto. If you got Bitcoin, you got fool's gold. That's not going to help. So you got to get rid of that, and you got to buy the real thing. And we make that easy at Schiff Gold, because you can take your Bitcoin and use BitPay and turn it into gold.
Good to hear. Good to hear. Peter Schiff, I thank you for giving us your time, and I hope we can do this again soon.
Yeah, sure thing. Take care.
That was Peter Schiff sharing his views on precious metals and the economy. To see more of Peter's views and work, please go to www.shiftgo.com. If you like this video, please do subscribe, give it a thumbs up, and share. All are greatly appreciated. Audio-only versions of this interview can be found on iTunes and Spotify.